Welcome back to Koala Finance. Here is the great paradox of the Australian economy right now. The headlines say the country is getting richer, but the average Australian feels poorer than they have in a decade. We are told that GDP is growing and that we have avoided a recession. Yet, real wages are stagnant, living standards are falling, and the cost of survival is at an all-time high. Why is there such a massive disconnect between the data on the news and the reality in your wallet? The answer lies in a silent economic crisis known as the per capita recession. Today, we're going to strip away the vanity metrics to reveal the true state of the Australian economy and explain why you feel like you're running faster just to stand still. If you rely solely on the headline figures presented in the nightly news, the Australian economy appears to be a picture of unwavering resilience. We are told that gross domestic product, GDP, is expanding, that we have avoided the technical recessions plaguing Europe and Japan, and that unemployment remains near historical lows. Yet walk into any supermarket in Western Sydney, attend a crowded rental inspection in Melbourne, or speak to a small business owner in Brisbane, and the reality is starkly different. There is a palpable sense of anxiety, a collective tightening of belts, and a creeping realisation that despite working harder than ever, the average Australian is moving backward. This is the great paradox of the modern Australian economy. The nation is getting richer, but its citizens are getting poorer. We are currently living through a phenomenon known as a per capita recession. It is an economic malaise that hides in plain sight, masked by the aggregate numbers, while the total size of the Australian economy continues to grow, driven largely by record levels of population growth and government spending. The economic output per person has been shrinking for consecutive quarters. This is the definition of a quantity over quality economy. We are inflating the lifeboat with more passengers to keep it afloat, but the rations available for each individual are dwindling. The great Australian dream, the promise that each generation would be wealthier and more secure than the last, is being eroded by a silent crisis of productivity and purchasing power. This documentary will peel back the layers of this statistical illusion. We will look beyond the vanity metrics of aggregate GDP to understand why your grocery bill has surged by 30%, why your real wages have reverted to levels seen in 2014, and why the Australian dollar is losing its buying power on the global stage. We are not merely facing a temporary cyclical downturn, we are confronting a structural shift in how wealth is generated and lost in this country. From the iron ore pits of the Pilbara to the mortgage belts of the capital cities, the old rules of prosperity are breaking down. To understand why you feel poorer, we must first understand how the machinery of the Australian economy has been re-engineered to prioritise headline growth over individual well-being. To diagnose the sickness at the heart of the Australian economy, we must look at the vital signs that the headlines often ignore. The most damning metric is real household disposable income per capita. This measures the actual purchasing power in your pocket after taxes and inflation are accounted for. Since early 2022, this figure has collapsed, effectively erasing a decade of financial progress. We have seen one of the sharpest declines in living standards among OECD nations, a statistical confirmation that for the average family, the crisis is not a future threat, it is the current reality. The mechanism driving this is a particularly stubborn form of sticky inflation. While the price of imported goods like electronics or clothing has stabilised, service inflation, the cost of things you cannot avoid like insurance, electricity, healthcare and rent, continues to surge at rates well above the Reserve Bank's target band. This internal pressure is compounded by alarming signals from our external lifelines. For 20 years, Australia relied on a terms of trade boom. The price of the iron ore and coal we dug out of the ground was historically high, while the cost of the goods we imported was low. That golden era is ending. As the Chinese property sector deleverages, demand for Australian steelmaking ingredients has softened, causing commodity prices to drift downward from their manic peaks. This reduces the flow of foreign capital entering the country, weakening the Australian dollar. A weaker dollar acts as a tax on every citizen, making imported fuel, cars, and machinery more expensive, further feeding the inflation cycle. We are facing a stagflationary wind, yet as growth is stalling, but the cost of living continues to rise. The price spiral is evident everywhere, from the rising cost of a morning coffee to the double-digit hikes in insurance premiums. These are not isolated price gouges. They are symptoms of a currency losing its strength and an economy struggling to produce value beyond digging rocks. To comprehend the mechanism of this entrapment, we must visualise the Australian economy not as an independent sovereign entity, but as a small vessel caught in a pincer movement between two colliding titans. On one flank, we have the People's Republic of China, which historically absorbs over 1/3 of our total exports. For 2 decades, the Australian Treasury effectively bet the house on the China thesis, the belief that Chinese urbanisation would require endless amounts of our iron ore and coal. This revenue stream acted as a national shock absorber, allowing us to mask structural inefficiencies with a flood of mining royalties. But as Beijing shifts its focus from building apartments to high-tech manufacturing and internal consumption, the insatiable appetite for Australian dirt is waning. We are exposed to a single customer who is slowly closing their wallet, leaving us with a budget structure that relies on boom time revenue in a slowing market. However, the threat from the other flank, the United States, is arguably more immediate for the average household. While China buys our goods, the United States dictates the price of our money. The Reserve Bank of Australia, RBA, likes to project an image of fierce independence, but the reality is that Martin Place is tethered to the US Federal Reserve. This is the brutal logic of global capital flow. Money seeks the highest risk-free return. If the US Federal Reserve keeps interest rates high to fight American inflation, the RBA is effectively forced to follow suit. If Australia were to cut interest rates to save our struggling mortgage holders while the US kept rates high, global investors would pull their capital out of Australia and move it to American bonds. This capital flight would crash the Australian dollar, sending the cost of imported fuel, electronics, and machinery skyrocketing. This is the definition of imported inflation. We are in a monetary straitjacket. We must import US interest rate policy to protect the currency, even if it means crushing Australian households with higher rates than our domestic economy can actually handle. We are paying the price for an American economic problem with Australian jobs. To measure the scale of the opportunity Australia has squandered and the precipice we now face, we must look to our peers. The most painful comparison is with Norway. Both nations are stable democracies with small populations and massive geological endowments. But while Norway treated its oil wealth as a volatile asset to be harvested for the future, Australia treated its mining boom as a permanent salary raise. Norway taxed its resource sector aggressively and funneled the proceeds into a sovereign wealth fund that now sits at over $1.6 trillion, effectively making every citizen a millionaire on paper. This fund acts as a national shield, insulating the domestic economy from global shocks. Australia, by contrast, spent its windfall on middle-class welfare and permanent income tax cuts. We spent our inheritance before we had even secured it, leaving us with a structural deficit the moment commodity prices softened. We chose the path of immediate gratification over generational security. But if Norway represents the path we missed, Canada represents the cliff we are approaching. Canada is effectively Australia's economic twin, a resource-rich nation with a banking oligopoly, a massive housing bubble, and a deep reliance on high levels of immigration to mask economic weakness. Canada is currently serving as the ghost of Christmas future for the Australian economy. They are further down the road of the per capita recession, grappling with a standard of living that is rapidly falling behind the United States. This is the classic symptom of Dutch disease. As the resource boom drove up the value of our currencies in the 2010s, it rendered our non-mining sectors uncompetitive. We watched our car industry die and our complex manufacturing wither, replaced by a simple dig and ship economy. Now, as the resource supercycle turns, we are left with a hollowed-out industrial base. We are a rich nation with the industrial complexity of a developing one, sandwiched between Uganda and Pakistan on the Harvard Economic Complexity Index. We bet the house on the mines, and in doing so, we forgot how to make anything else. The transmission mechanism from the macroeconomic stratosphere to the kitchen table is direct, brutal, and centered on one obsession: residential property. For 30 years, the wealth effect of rising house prices concealed the cracks in the Australian economy. We felt rich because our homes were earning more than we were. But today, the housing market has decoupled from the real economy, morphing from a generator of wealth into a predator of liquidity. We are witnessing a grotesque paradox. Property prices in many capital cities are pushing back toward record highs, even as the human beings living inside them are undergoing a recession. This is not a boom driven by prosperity. It is a squeeze driven by scarcity. The per capita recession is intimately tied to the housing shortage. With net overseas migration running at historical highs, we have imported record demand into a market with collapsed supply. We are currently facing a shortfall of hundreds of thousands of homes relative to the National Housing Accord targets. This imbalance has turned shelter into a luxury good. For the 1/3 of Australians who rent, the crisis is existential. Vacancy rates hovering near 1% have created a landlord's market of brutal intensity, sucking disposable income out of the economy and funneling it into passive rent seeking. Every extra dollar spent on rent is a dollar not spent in a local cafe, a retail store, or a small business. The housing crisis is effectively strangling the consumption economy. Meanwhile, for the mortgage belt, the fixed rate cliff has evolved into a long, grinding attrition. The zombie household has emerged as a new demographic category. Families who are technically solvent on paper but have zero disposable income after servicing their mortgage and essential bills. The banks, currently holding loan books that are 60 to 70% residential mortgages, are uniquely exposed to this stress. The Big Four are no longer just banks. They are massive real estate hedge funds with a banking license attached. To protect this exposure, the entire financial system is geared toward keeping property prices high, even if it means sacrificing the living standards of the working population. We have created a two-speed society, an asset-rich older generation insulated from the pain, and a working-age population drowning in debt, running faster just to stand still. In the corridors of power in Canberra and Martin Place, the realisation has finally set in. The autopilot era of the Australian economy is over. We are currently witnessing a high-stakes policy tug-of-war between the Reserve Bank of Australia, RBA, and the federal government. A conflict that is adding volatility to an already fragile system. This is the incoherence problem. The RBA is frantically pulling the monetary brake to slow inflation, while the Treasury is pumping the fiscal accelerator to support a slowing economy and greenlight a manufacturing renaissance. The RBA, led by Governor Michelle Bullock, is attempting to navigate a narrow path, bringing inflation back to the 2 to 3% target without crashing the economy into a deep recession. But as we move into 2026, that path has become a tightrope walk over a canyon. Despite earlier rate cuts in 2025, taking the cash rate to 3.60%, inflation has proven stubbornly sticky, particularly in the service sector. The RBA is now trapped. If they cut rates further to save sinking mortgage holders, they risk reigniting inflation and crashing the Australian dollar. If they hike rates to kill inflation, they risk pushing the zombie households and the construction sector into mass insolvency. They are effectively frozen, forced to hold rates in restrictive territory for longer than anyone anticipated, waiting for the economy to crack just enough to cool prices, but not enough to cause panic. Simultaneously, the federal government has launched its answer to the geopolitical squeeze, the Future Made in Australia Act. This flagship policy, with over $22 billion in public funding, is designed to pivot the nation from a dig and ship quarry into a renewable energy and critical minerals superpower. On paper, it is a strategy of economic sovereignty. subsidising green hydrogen, processing our own lithium, and reviving domestic manufacturing. However, critics argue this is a risky gamble on picking winners in a high-cost nation. By injecting billions into the economy to build new industries, the government is adding demand at the exact moment the RBA is trying to crush it. We are effectively fighting inflation with one hand and feeding it with the other. The result for the average citizen is a prolonged period of mixed signals. Government rebates that temporarily lower bills, followed by persistent underlying price rises that keep interest rates painfully high. For the individual Australian investor and household, this new economic regime necessitates a complete rewriting of the financial playbook. The strategies that built wealth in the last decade, leveraging heavily into residential property and counting on a rising tide to lift all boats, are now fraught with risk. In a per capita recession, the rising tide has stopped. We have entered a zero-sum environment where protecting wealth is as important as creating it. The most dangerous bias facing Australian portfolios today is home bias. We earn in Australian dollars, own Australian real estate, and have our superannuation heavily weighted toward Australian banks and miners. This is a concentration risk of the highest order. If the China thesis fails or the AUD continues its structural decline, every aspect of your financial life takes a hit simultaneously. A robust survival strategy now demands true diversification. This means looking beyond the ASX 200 and allocating capital to global markets that are detached from the Australian business cycle. Holding unhedged global assets, such as US tech stocks or global index funds, acts as a critical insurance policy against a falling Australian dollar. If the AUD drops to 60 US cents, your foreign assets effectively rise in value in local terms, offsetting the higher cost of living. Furthermore, the logic of debt has inverted. When interest rates were near zero, debt was a wealth accelerator. In a world of higher for longer rates, non-deductible debt, like your home mortgage, is a wealth destroyer. Paying down this debt is now arguably the best risk-free investment available, offering a guaranteed tax-free return equivalent to your mortgage rate, often beating the returns of the volatile stock market. Finally, we must address the asset that never appears on a balance sheet, your human capital. In a recession where per capita output is shrinking, job security is no longer guaranteed by national growth. The labour hoarding of the post-pandemic years is ending, and businesses are looking to cut costs. The ability to pivot, upskill, and maintain income stability is the only true hedge against the rising cost of living. The era of the passive investor is over. The new era demands active defence, global thinking, and a realisation that the government cannot bail out everyone. As the dust settles on our analysis, the conclusion is inescapable. The lucky country has run out of easy luck. For 30 years, Brexit, Australia defied economic gravity, is skipping recessions and riding the coattails of the greatest resource boom in history. We outsourced our manufacturing, inflated our housing market, and assumed the good times were a permanent feature of our geography. But the per capita recession is a warning bell we can no longer ignore. It signals that our current model, reliant on population growth to mask declining productivity, has reached its mathematical limit. We are growing larger, but we are not growing stronger. This does not mean the Australian story is over, but it does mean the plot has twisted. We are standing at a fork in the road. One path leads to a drift, a slow, comfortable decline where we become a high-cost, low-complexity nation surviving on the fading fumes of the mining boom while living standards slowly erode. The other path is harder. It requires genuine tax reform, a break from our addiction to property speculation, and a serious commitment to becoming a productive, complex economy that makes things the world actually wants. For you, the viewer, the takeaway is clear. Do not wait for the national ship to steer itself. The macroeconomic currents are powerful, but they do not dictate your individual outcome. By understanding the forces at play, the sticky inflation, the geopolitical squeeze, and the housing trap, you can position yourself not just to survive the squeeze, but to find opportunity in the volatility. The days of the free ride are gone. The bill for our prosperity is due, and it will be paid by those who are unprepared. But for those who are watching, learning, and adapting, the future is still unwritten. Do you feel a shock every time you tap your card at the checkout? You are not alone. While Australian families are struggling to put food on the table, two companies are posting billions in profits. In our next investigation, we're going to expose exactly how Colesworth rigs the game against you. You do not want to miss this. Hit subscribe and turn on notifications for the supermarket duopoly. How Coles and Woolworths control what you eat.